First up is, will the Bank of Japan hike interest rates at their December meeting? Well, for now, the focus has currently turned to the upcoming US Federal Reserve meeting, or FOMC, on the 9th and 10th of December. For global investors, however, the Bank of Japan on the 18th and 19th of December may be more important. Now, they're expected to hike rates because inflation remains at the top end of the 40-year range. And many economists are arguing that Japan is now undergoing a generational shift from a declining rate environment to a long-term rising rate environment. And Japan's 10-year yields could be about to break to a 25-year high. In fact, the Bank of Japan may even signal more hikes are to come in 2026. The next question is, are the risks increasing that gold prices could collapse? Well, the gold price currently has many structural supports. Central banks have been diversifying away from US Treasuries towards gold to reduce their reliance on dollar instruments. And furthermore, gold is still considered to be a store of value in a global environment of rising government debt and currency debasement. And we can see that the gold rally is even more emphatic when placed in other currencies like the Japanese yen. So whilst gold prices are stretched with many late arrivals to the market, the longer term themes supporting the gold price do remain unchanged. And our final question is, will the current Chinese equity market rally become a bull market? Well, we've been here before. The Chinese equity market has rallied many times in the last 25 years, only to roll over and disappoint investors. In fact, we're only a few months out of a 4-year bear market. So could this time be different? Which are very famous last words indeed. What could have changed? As we've already seen, China has moved away from an all-out growth strategy to one that aims for sustainable growth centered around demand and domestic consumption. And much of the pain of the last few years was part of that realignment of resources, as well as the aftermath of the drastic response to COVID in 2020. Today, China's economy has been redirected towards a longer-term resilience focused on new technology via volume and value. Rather than competing with the Nvidias of the world, the aim is to provide affordability for a mass market. Now, understandably, investors will remain wary of the credit and debt overhang. But today's economy and markets are being built for resilience. Investors have therefore preferred to focus on those sectors where China has taken a lead, like electrification and driverless cars. And as you all know, investing is rarely smooth, but China's leaders have indicated that they would like the extreme swings of the economy and the market to now be a thing of the past.